So whenever I have anything that's beyond my technical understanding, there's one man I like to chat to because his technical understanding far exceeds mine in anything of this whole space. So I'd like to welcome our friend Chris Coney. Are you there, Chris?
I am here, Ash. Nice to meet you again, mate.
Fantastic. And we were going to have a chat today about stablecoins.
Yes, that's what I think is going to be the hot topic of 2019. I think it's going to be the year of stablecoins.
Now, from a layman's perspective, can you kind of describe the basics of what a stablecoin is and why they exist?
Sure. So one of the criticisms of anyone getting involved in crypto is, they're too volatile, and then the price is all over the place. And people say if they're cryptocurrencies, this is the argument. People say if it's a currency, I need to be able to spend it. And because Bitcoin has been rocketing up in price so much over the last few years, or in 2018 down in price, when it's going up, it's a disincentive to spend it, because if it's going to be worth more tomorrow, people would rather hold on to it. That's not a currency, right? If people don't want to spend it, that's the argument. So that then brings the need for some kind of cryptocurrency that doesn't move around. So fine, speculate on Bitcoin as the digital gold, as an asset, but it no longer becomes a currency if you just want to hold it forever. So that gave birth to the need for some kind of stable cryptocurrency that doesn't fluctuate, that can then provide sort of a ground state for everything either to be traded against, or so we can use a crypto to actually buy and sell stuff between each other without worrying about it going up or down in price. So that's where the need for it came from, basically.
So with Tether, for example, you could, rather than going backwards and forwards to fiat the entire time, you could basically go into USD Tether, which is pegged to US dollar, exactly, and use that as your trading mechanism, because it's always one is always going to equal a dollar. Exactly.
So what used to happen is that the original idea was that Bitcoin was going to become kind of the reserve currency. So that on the exchanges, for example, Bitcoin would be the currency everything else was traded against. So you'd go from Bitcoin, you'd use the Bitcoin to buy some LiteCoin, and then you'd sell the LiteCoin back into Bitcoin. And that's how you know if you made a profit or not. If you do have more Bitcoin after the trade than before it. The trouble is, Bitcoin's fluctuating in relative terms at the same time. And because we all still think in fiat currency terms of pounds, dollars, and euros, it's just still too alien. So you've got the price of Litecoin fluctuating in relation to Bitcoin, and then Bitcoin fluctuating in relation to pounds, dollars, and euros. That just cooks people's heads. So Tether came along. It was actually the first attempt at a stable coin. So Tether itself, the USDT, it's a cryptocurrency token, so it can be traded on the blockchain in the digital space. But the way a Tether comes into existence is when you deposit a US dollar in the bank account of a company called Tether Corporation. So that means there's an offline dollar for every online dollar. So you can play around in the crypto space with your Tether token, trade it for Bitcoin, and whoever ends up with it, they can always redeem it for an offline dollar, which is how it maintains its stability.
So really it's like back to the old days where you could walk into a bank and redeem a pound's worth of gold or a dollar's worth of gold for your node.
Right. I think that's, in economics, you call it a value anchor. So how do you prevent, pure market forces from moving the price around? Bitcoin really, that's why the price is so volatile, because it's pure supply and demand. It's a pure market in that way, which is great because it's a money of freedom. However, practically, you can't have something like that volatile.
And in terms of this, will this help once these? There are more than one stablecoin, obviously. Every time I open one of my sort of news sources these days, it's new stablecoin. These guys are doing a stablecoin. These guys are doing a stablecoin. Presumably, that's going to help kind of larger scale investors actually get into the space and avoid the volatility that precludes them from doing it.
Yeah, it's funny they've all come along now. Tether has kind of had the place to itself for years because it was the first, and I don't understand why that had more competition before now. But Tether just kind of took off over the last couple of years and got to the point where about $2.5 billion a day of Tether was transacted. And then one by one, the various different exchanges started listing Tether because it's easier from a regulatory point of view to list Tether trading against a given cryptocurrency than it is to start accepting US dollar deposits and then having to secure those dollars, that's a whole different ballgame. So it's easier for someone like Binance, which is a pure cryptocurrency exchange that doesn't want to really get involved with handling fiat currencies. They can just list a tether against Bitcoin, tether against Ethereum, boom. And then they've got essentially a dollar market with that stability. What's happening now is that tons of people are jumping on the stablecoin bandwagon. Like the Gemini exchange has now issued its own Gemini dollar, right? Where same thing, for every US dollar they have in their bank account deposited by a client, they mint a Gemini dollar, which actually lives on the Ethereum network. It's powered by that technology and can move around the Ethereum network. People can earn their wages and salaries in Gemini dollars. And the reason it maintains its value is because whoever's got it, it's like musical chairs, whoever ends up with the Gemini dollar, when the music stops, they can always go back to Gemini and burn that Gemini dollar and get a real US dollar.
So that's interesting that it's on Ethereum. So in terms of, again, this is beyond my knowledge level, but in terms of different stable coins are pegged on different blockchains. Is that kind of how it works?
That's right. Tether is built on something called the omni-layer protocol. This is an old technology way back from when Bitcoin first started. The idea of the omni-layer was that you could have Bitcoin and then you could turn it into what you call a colored coin. So imagine the orange Bitcoin logo. So that would be like the pure Bitcoin or like a gold coin. Imagine if you could then use that Bitcoin but turn it into a blue Bitcoin, and it would have my personal traits to it. And that's really what the omni-layer was for. It was to allow you to create other tokens or build them on top of the Bitcoin network, right? So that was what the omni-layer was for. And that's how Tether exists. It actually runs on the Bitcoin network thanks to this layer of technology called the omni-layer. The downside to that now is that if the Bitcoin network gets to full capacity, which is easy to do, that's a problem because Tether then gets stuck in the queue. And also if Bitcoin fees go up, say if the Bitcoin fees got to where they got last year, where they're in multiple dollars per transaction, if you want to transfer 5 Tether tokens worth $5 and the transaction fee is $2, doesn't work at all. So that's a problem. So Ethereum's way more functional, way more flexible. So the Circle dollar, the Gemini dollar, the Pax stablecoin, these are all built on Ethereum so far.
Any danger of are they side chains, or is there any danger of another CryptoKitties debacle where it can't handle and the fluctuation in gas price?
Yeah, Ethereum has the same problem. It's at X capacity every day now, Ethereum. And again, fees, it's a problem. That's a big problem. So there are other stablecoins on other networks, like BitShares has a few of them. It has the BitUSD, the BitOne, the BitYuan, the BitRuble, the BitPound, etc. So they're different in the sense that they're then moving into the realm of algorithmic stablecoins, where the value isn't stabilized by being backed by anything other than, it's not like a derivative. So the BitUSD, for example, is backed by BitShares. So BitShares is a blockchain. It has its own token called BitShares. That's supposed to be for paying fees on the BitShares network, which is a decentralized exchange. But you can lock up BitShares, say a minimum of, say, $2 worth of BitShares as collateral to back a BitUSD. So that's how a BitUSD maintains its value, by being backed by collateral. And the collateral is BitShares in the case of the BitUSD or the BitOne or whatever. So I think I explained that reasonably clearly.
It's a really good explanation, actually. It makes it a lot clearer and easier to understand for me. I mean, one thing I've been struggling to get my head around is with this kind of Tether debacle that's been going on it's been going on for a long time, but over the last week there's been quite a lot of heat on it. Have you got a sort of simple explanation there? I think I understand what's going on, but what's the argument there?
Right, so this is the thing. I'm surprised that Tether has had the place to itself. The other reason I'm surprised it's had the place to itself is because there's so much controversy has been surrounding Tether since the last few years. So going back to the principle that the reason a USDT, a Tether token, maintains its $1 value is because you have the confidence that at any time you can give that Tether token back to Tether Corporation and they will send $1 to your US dollar bank account. So it relies on you having absolute certainty that if you have 1 million Tether tokens, or if there are 2 billion or 100 billion Tethers in existence, it's based on you having absolute confidence that there is at least 100 million US dollars in the bank for every Tether in existence. That's never been proven. The Tether Corporation has consistently failed to provide audits on their bank balances versus the number of Tether have been minted. So for the last couple of years, a multi-billion-dollar cryptocurrency like Tether has maintained its peg and maintained billions of dollars a day in volume without proof that it's backed 100%, which is gobsmacking.
That takes us back to fractional lending kind of nightmares, I guess.
And they may be banking on the fact that, just like the old banking system, only 10% of people are going to redeem it at any one time. So they can amplify the supply by 10 and still make money. Because the way the Tether Corporation makes money is they charge a 1% fee on the way out when you redeem it. So they just want volume. So there's an incentive. I'm not accusing them of anything. I'm just saying in the game theory, economic dynamics of that game, there is an incentive for them to jack up the volume without having the money there. But it's never been proven either way, so that's where we're at.
So I guess ultimately, stable coins are not going anywhere. They're the future, and with them in existence, it's going to hopefully allow larger funds to come in, allow kind of other people to get in. I mean, is there any danger of there's going to be too many stable coins and that it will be that whoever's the strongest stable coin survives and becomes effectively the reserve currency?
It's a good point. It is a very good point. The difference with, like, say, the actual US dollar, and there are multiple dollar-based stable coins, like the Gemini dollar, like the Circle dollar, like Tether, they're all stable coins based on the same fiat currency. So we're going to start dividing the liquidity for the same currency, which is kind of weird. That's really weird. So it would be okay if we had like one stable coin for the yuan and one for the Japanese yen and one for the pound and one for the euro. But what if there are multiple stable coins for the same currency? It's going to split up the liquidity. What's going to happen then, I think, is that the stable coins are going to start trading against each other. Because on the Kraken exchange, there's already a US dollar Tether market, which is what? No, that's like actual dollars deposited with Kraken that are trading against the Tether stablecoin.
Arbitrage, basically? Or?
Exactly. So that's actually how all of the US dollar stablecoins will maintain their peg, is that if one of them gets away by like 97 cents, well, there's a 3% profit margin there. And especially if like was another one, True USD, which is dollars held in trust, say that goes up like yesterday to $1.06. So you've got $1.06 coin, 97 cents coin. Well, there's a 7% spread there. That's a 7% opportunity for somebody to close the gap, So that's a good thing.
I'm sure there's bots all over at the moment, arbitrage bots looking for those opportunities and someone making money. I mean, what's your sort of prediction on the? Do you see there being kind of one of these stable coins is going to become, the one, or do you? What's your thoughts on it?
Okay, I prefer not to use these deposit-based stable coins like your Gemini dollars or your Circle dollars, because the actual value is held by a centralized party like Circle or like the Gemini exchange. And I'm not having a go at the Gemini exchange, but I keep mentioning this key point. I read the Gemini dollar white paper, and it specifically says in there that they have the ability to stop transactions of Gemini dollars. So they have sort of admin control over the smart contract that powers the Gemini dollar. Now, I don't think they're going to do anything evil with it. I think because Gemini are based in New York, heavily regulated, the only way they're able to maintain their regulatory license is by having features like that built in. The regulators would have imposed that requirement on them. So it's not their fault, right? They're having to comply. But that puts me personally off using it. So I would much prefer these free market coins like the BitUSD, or actually my favorite one, which is yet to actually be launched, is called the KUSD, which is the koala dollar. This is different in that it's an entirely dedicated blockchain. So it's a completely separate blockchain with one purpose, which is to maintain the stability of the koala dollar. And the koala dollar maintains its value purely by supply and demand. So the algorithm, if the koala dollar gets to $1.01 in value or $1.02 in value, it automatically creates new coins to reduce the scarcity and bring it back down to $1. And likewise, if it goes 97 cents, it will destroy koala dollars to bring it back up again, right?
That's clever.
It's very clever. And the best bit about it is that the koala dollar, you can actually store it on your Ledger hardware wallet, which is huge. So this is completely separate to any centralized institutions or anything like that. And it's algorithmically stabilized. So that's my personal favorite one, which I would like to see take over.
Amazing. Well, as always, you've answered my questions and much more. So thank you for coming in and having a chat. It's always a real pleasure.
Likewise.
Thank you so much, Chris. And hopefully we'll get to chat soon.